studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning and we're coming to you live from the CNBC-TV18 News studios. It's an important day because of what has happened in the last 12 hours or so with respect to that Fed decision and markets which have taken it not very well. I'm Prashant, with me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi,
Morning.
good morning. I want to know, did you stay up to watch the Fed?
Even I was
That was your question. Tell us the truth.
I mean, I think that I told you guys this, right? The last time I think I sat up and watched markets was, I think, for a brief bit in 2020 where markets were all crashing, etc. And before that was 2008. So crisis to crisis.
Okay.
No crisis right now. So
That's a good sign, actually.
Let's just quickly then take this forward with what you need to know as far as the trading activity and trading action is concerned. So the Fed decision came through, and as expected, there was no change. But the policy, on a whole, I would say, was more hawkish than expected. And the reason is very simple. Basically, the Fed's forecast of, not forecast, but their assessment of the U.S. economy is much stronger than expected. They've raised GDP growth forecasts for 2024 and 2023 and 2024. And they've brought lower how many rate cuts are going to be. I mean, their forecast of rate cuts by 50 basis points, both for 2024 and 2025. So, if markets were expecting 100 basis points, now they're expecting 50. I mean, they should expect 50 basis points if you go by Fed's forecast. And this is the reason why, I'm saying that this was more hawkish than expected. You can flip this around and say that, the Fed does not see a hard landing. They see a very soft, smooth landing. No recession as far as their forecasts are concerned. But the point is that would also mean that rates perhaps would need to be higher for longer. No rate hike, as I said last night, but, the statement was unchanged, which means that there perhaps is going to be one more rate hike sometime in 2023. And beyond that, the quantum of rate cuts has been brought lower. So what did we see, right? I mean, the dollar index, if you needed any evidence for market reaction, you could look at the dollar index pre-FOMC and post-FOMC. So the DXY basically went from 104.6 to 105.36 over the course of the FOMC decision and the Powell press conference. So that was quite something. Yields popped higher. The 2-year closed above 5.17%. I mean, that's, quite high. The 10-year basically ended at the highest, I think, since 2006. So that's now at about almost 4.4% or so. And of course, the yields feed into the dollar feeds into what's happening on the yields, and equities were lower. So if you look at the NASDAQ, that was down about 1.5% overnight. S&P was down. The entire complex was down, not in a very large way, but there were cuts, as you can see up on your screen. You could say that we kind of preempted some of that yesterday because the Nifty and the Bank Nifty both saw sharp cuts by about 1% or so, a little over 1%. It was lesser so on the mid-cap index, which lost about 0.25%. The small-cap index lost just under 1%. So the larger cuts were in the Nifty and the Bank Nifty, largely because, of course, HDFC Bank. But to kind of limit ourselves for now on the levels you need to watch out for, what we're basically looking at is retracements now. If you look at the retracement of the rally on the Nifty and the Bank Nifty from the August 31st low to the September 15th high, basically 15 days, lesser in terms of trading sessions, the 38% retracement of this move is the first support. That comes in at 19,840. Most likely we'll kind of breach that right at open. So then the next one will be the 50% retracement of that rise, 38,650 and then 61.8. The 50% retracement is 19,723. Will we get to that number in this leg of the pullback correction move? I think so. Let's watch out for. So I think, a safer, more if you're trading, a buyable kind of zone would be closer to about 19,700, 19,750 or so, and not the first gap down that you see. Resistance is perhaps at the gap area between 20,050 and 20,115. This is the gap between the sell-off, Monday's low and yesterday's high. So that's 2050 and 2115. On the Bank Nifty as well, we closed near the 38% retracement, same sort of rise, right? In the case of Bank Nifty, it's not 31st of August, but 1st of September to 15th of September. The 38% retracement of that is 45,363. We closed around that. The real supports then come in at the 50 and the 61.8% level. So that stands at 45,070, which is about 400 points, not even 400 points away. And then 44,778, which is the 61.8%. That's a big one, which you need to watch out for. And resistance for the Bank Nifty, similar gap area, which is in the case of Nifty Bank is 45,726 and 45,907. Don't do anything right at the word go. Let the market settle a little bit, stew a little bit. We've had a nice run. The first signs of a bit of a pullback yesterday, at least on the large cap. So, give it time for things to settle in. And I mean, if you see, prices coming to the lower bounds that I mentioned, both on the Nifty and the Bank Nifty, that's a much better risk reward rather than, trying to buy the open right on the gap down. Sonia.
Absolutely. And, the GIFT Nifty for now is implying a 120-point cut, right, in trade. So we're going to start off straight off the back with a gap down opening in trade. And then, of course, we'll take it from there. I think the big focus area, at least for me this morning, is the IT space. So generally, when, there are higher rates in the system, growth sectors like IT see some compression in terms of valuations, etc. So that is definitely going to be one space that I'm looking at today. NASDAQ, where, a tech-heavy NASDAQ saw a big fall yesterday. It was down about 200 points, although the Dow ended with mild losses. So perhaps you could see disproportionate pressure in the IT sector. So that's that. As, Prashant was also pointing out, the Fed has been signaling or has signaled higher rates for longer. The exact statement verbatim is Jerome Powell saying that we are prepared to raise rates further if appropriate. So it's going to be very, very data dependent from here on. But the problem for our markets is, even in trade yesterday, you saw a secular fall. So there's profit booking across the board, whether it's HDFC Bank, whether it's Reliance, whether it's in PSU banks, which have rallied so much. And now today there will be pressure in IT. So there is no leadership pocket in the market that will hold fort, at least at the start of today. Then, of course, we'll take it from there. Both foreign and domestic investors, in fact, sold in the cash markets yesterday. And if you look at it, it's been 2 days of large FII selling, and put together in the month of September alone, FIIs have sold almost 14,000 crores. So, it's not a great picture that we're looking at the moment. And of course, the Nifty closed below that 20,000 mark yesterday. Another asset class to track closely now is the move in gold. Gold prices have started rising. It generally happens when risky assets take a backseat on account of higher rates. So just these are how the internals are stacked up. Of course, today looks like it's not going to be a good day for the bulls, but then we'll take it from there.
Well, that's right. Sona, the only good point about yesterday and today is yesterday maybe we preempted some part of this fall, because the Nifty and the Nifty Bank, it was a very, very weak close. There's no two ways to describe it. The intraday chart, if you just look at it, the last stick was actually the low point of the day. As I said, only lone positive could be maybe we preempted the hawkish pause that we saw from the Fed. But there's no big shorting that we're seeing in the system. And actually, this market had got very, very complacent. There were long positions getting added on a day-to-day basis. So yesterday as well, we had a lot of unwinding of long positions. And from the FIs as well, they unwound long positions big time, though they continue to remain net long with their positioning at around 61% odd. But massive unwinding of long positions is what we saw. There's another technical factor that you normally track. That's the PCR. It was at around 1.2 odd. It's come down to around 0.79. Remember, when it goes to around 0.65, 0.7 odd, that's when we see the markets, see a bit of a near-term relief rally. So that could be one trigger you'll have to keep your eye out on. And why has the PCR come down so drastically? Because two strikes were very, very active yesterday. 20,000 call, you had the 19,950 call. Between them, they added more than 2 crore shares out there. And there was aggressive writing that we saw. That's about the call side. On the put side, well, you had the 19,900 put. That has the highest open interest. Premium out there was roughly on an average of close to around 50 rupees odd. So on the downside, on a closing basis, you don't want to see that lower level getting violated. That's 19,800, 19,850 for starters. We'll start around those levels, but on a closing basis, you'll want to defend that. Otherwise, you slide down to the 20 DMA, which is at around 19,650 odd. The Nifty Bank, that played out a weak close yesterday, and there was aggressive call writing that we saw. 45,500 call, premium roughly around 400 rupees odd. So that 45,800 to 46,000 odd mark, that becomes a key resistance zone. And on the downside, you're looking at the 20 and the 50 DMA. That's 400 points away from current levels. So you'll want to keep an eye out on that. The GIFT Nifty is suggesting a pullback. As I said earlier, the only good news is yesterday we ended at the day's low. The bulls will be hoping for a bit of a bounce today. Let's see how this one goes.
All right, Nigel, thanks for that. But before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Peter Cardillo of Spartan Capital Securities will join us to discuss the global trade setup. Our research team, a little later after that, will get you CNBC-TV18's list of top stocks for the day. At 8:30, Hemang Jani will be our market expert to talk about what he likes in this space.
All right, let us quickly begin the show with a comment coming in from Eric Fishwick of CLSA, who says that the Fed has left rates unchanged. This is in line with expectations, and the meeting was more important for changes to the Fed's forward guidance. The guidance for rates this year was left unchanged. The median Fed funds projection for end of 2023 remains 5.6%, but has risen to 5.1% from 4.6% for 2024 end. They have long argued that the Fed would want to keep rates higher for longer, but this is more hawkish than what the street was expecting.
Another equity call, this one from CLSA's Lawrence Belanco, who says that they continue to flag the vulnerability of the Indian NSE mid-cap space. He says the bearish intraday reversal recorded on the 12th of September, which is last Tuesday, reinforces their call on the 1st of September, which was to take profits. He says a break below the 20-day moving average on that index, currently at 39,780, which has acted as a key support level since the mid-cap index broke out of the 2021-2023 consolidation pattern in May, would add further evidence that a consolidation pattern is unfolding. He anticipates further corrective price action off the September 12th high that at the very least is set to take the mid-cap index back towards 36,874 to 38,148 area in the coming sessions. He says in addition to Power Finance and IDFC First Bank as take profit candidates, they would add Trend, MRF and Max Healthcare.
Okay, let's also get you some money market views this morning and tell you how to approach that space. Parul Mittal Sinha of Standard Chartered Bank says higher crude oil prices, stronger US dollar post the FOMC and a wider than expected merchandise trade deficit is likely to keep the rupee on a weaker footing. However, she expects the dollar selling by the RBI to smoothen any sharp moves, and thus the dollar INR pair is likely to trade in a broader range of 83 to 83.40 next week. Any positive news on the bond index inclusion can, however, see a break of the range on the lower side.
Okay, well, that's the rupee outlook. On bonds, she says that the 10-year benchmark bond yield is expected to trade between 7.15 to 7.25%. She says expectations of slowing domestic inflation and optimism around index inclusion is likely to keep rates supported despite higher crude oil prices and U.S. Treasury yields. Hawkish FOMC dot plots showed fewer cuts in 2024. She adds a more favorable supply-demand balance from October is also likely to keep bond yields contained. Any positive news on index inclusion can see a move towards the 7% levels.
Well, we have a lot of stock-specific action to track for you. We get to that in just a bit for now, but for the timing, let's highlight all the stocks that we will be covering in our special Top 10 segment. We're looking at Sheila Foam, Strides Pharma, Biocon, Exide Industries, MCX, Sri Renuka Industries, and those are stocks on the back of positive news flow, while on the flip side, you have SJVN, Cipla, Apollo Tyres, and Fino Payments Bank that could be reacting to negative news flow.
Okay, well, Peter Cardillo is joining us now. He's Chief Market Economist at Spartan Capital Securities. Peter, good morning. Good to have you with us here on the program. You know, there is some disbelief I can sense from many sort of Fed watchers and macro watchers, etc., saying, well, is the Fed really saying that there is no recession all the way till 2026 or 27? So, you know, it's going to be higher for longer. Is that the way to read the policy and the statement of the Q&A from last night?
No, I don't think so. In fact, I think Fed Powell was quite clear, especially during the conference, during the press conference, that he said, the risk can be either way. He did reiterate that the path to a soft landing remains, but he also said that under-tightening and over-tightening could be a problem. So the fact that they're poised to raise rates one more time, and then, of course, it's data dependent, that, suggests that somewhere along the line, we're going to have a consumer recession. The high cost of financing credit, especially credit cards, is weighing on the consumer. And you could see that. I mean, we've had some fairly stable and good retail sales numbers. But as we get closer to the holiday season, most of the indications are that the consumer is not going to spend as heavily as they did in the previous years. And that's because, the American consumer spends on credit cards. And so they are spending their way. And this is a problem when you have high interest rates. And then, of course, the other problem that we have is high oil prices. Gasoline prices here in the States have gone up, and they're not really that far away from their high point of the beginning of the Ukraine-Russian conflict. And so that's another factor. The American consumer is likely to think not once, but maybe several times before he spends on items that are not necessary. In other words, the consumer is getting strapped by the high rates. And so I think the Fed is wishful thinking that a recession cannot happen in 2024. I admit that I was wrong. I admit that I was wrong.
Peter, sure. Sorry, we are actually running a bit short of time, so I wanted to squeeze in a couple of more questions. For the viewer watching you right now, largely the Indian viewer, the only question on his mind is, if rates are going to be higher for longer, does that mean like risky assets like equities take a back seat for the rest of the calendar year? Is that your view?
No, not necessarily, because I think, if you look at the yield curve has been doing what it has been doing, and the stock market continued to rally. So I think the next catalyst, there are two next big catalysts, and that is the inflation data and, of course, Q3 earnings. And if Q3 earnings come in slightly lower than the previous readings, I think the market will probably rally. Now, are we looking at an explosive rally? That's questionable. Are we looking at a strong sell-off? That I don't think, because a lot of what the market was expecting from the Feds came to fruition.
Hi, Peter. Good morning. Peter, from an India perspective, we also track two big indicators. One is Brent crude prices, which have surprised everyone, moving to $90 per barrel plus. We don't like that too much. And the dollar index as well has strengthened. Where do you see both those two asset classes headed?
Yeah, I remain short-term bullish on the dollar. I think the dollar index is headed to around 96.25. And as far as oil is concerned, from a fundamental viewpoint, the price is rather high and rich at this point. Technically, the market remains strong, although over the past several days, we did have a battle between the bulls and the bears. When I say that, I mean there was resistance around that 92.5, 93 level, and the market failed at least 3 times, breaching to the upside. So that suggests that while the technical outlook remains strong, probably we're not going to see oil prices move to the high 90 area until we clear this resistance level.
All right, Peter, we'll leave it there. Thank you very much for your time. It's a pleasure having you with us here on the program. Thanks indeed for your perspective on the Fed and, of course, where markets, etc. stand. We'll take a quick commercial break here. We'll come back. Our research team will be joining in with the top 10 stocks for the day that you need to watch out for on the back of news flow. That's coming up next. Stay with us.
Welcome back to Bazaar Morning Call. Looks like it's not going to be a great start to trade today. So there are plenty of pressure points, and the GIFT Nifty is indicating that the start will be about 130 points lower. But our research team is standing by to give you the list of stocks that you need to focus on as we begin the day. There's SJVN and Sheela Foam that Vivek is tracking this morning. Vivek, over to you.
Well, good morning. Both stocks important to watch today. SJVN, the government is now looking to sell close to 4.92% stake in the company via the OFS route. 2.46% stake would be the base size, and another 2.46% would be the oversubscription or the green shoe option that the government could exercise. Now, the floor price for this particular OFS is coming at close to 69 rupees a share, which is a steep 15.5% discount to yesterday's closing price. So, on the back of that, you could see some pressure on the stock. Remember, the government held 59.9% stake in the company at the end of the June quarter. Now, the other stock on our radar is Sheela Foam. Now, sources indicate that Sheela Foam is looking to raise close to 1,200 crore, and this is going to be done via the QIP route. The base size of this particular QIP is close to 1,000 crore, and with the upsize option of 200 crore, indicative issue price indicates up to a 7.8% discount to yesterday's closing price, and the dilution at that price would be close to 11.4% of the total equity capital. So what we understand is that this particular funding or this particular QIP proceeds would be done in order to go ahead and fund the acquisition of Kurlon Enterprises that the company has envisaged.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Ekta. She's here to run us through a few pharma stocks that are on focus. Morning, Ekta.
Morning. Well, I'll start with Biocon, which is in focus because Biocon Biologics has got the European Union approval for their biosimilar Aflibercept. Now, the approval is by the European Commission. The EC decision follows an approval by the Medicines Agency of Europe, which had given a positive opinion in July for this particular biosimilar. So the street was anticipating this approval. Now, this is an ophthalmology product. It's used for eye conditions. Why is it important? Is because it's $1.8 billion in terms of market size in Europe. And for the US, the market size is around $6.26 billion. So that's how much the reference product generated. So this would be a positive reading because it is a developed market approval that they've received. And it's a large size drug where there is expected to be competition, but still a formidable opportunity for Biocon. Cipla US facility in the US was issued 5 observations. Their Invigen facility in New York was inspected by the US FDA. They've said no repeat or data integrity observations. Lastly, Strides is what I'm watching. The board is going to be meeting on the 25th of this month to discuss a restructuring which was proposed by the company in Q1 of FY24, which is to combine the CDMO interests of the group. There's an analyst call at 5 p.m. on Monday as well. So the stock would be in focus on account of that.
All right, Ekta, thanks a lot for that. I'm watching out for 2 stocks this morning. One of them is Apollo Tyres. There's some negative news flow on that one, so I'm going with red on Apollo Tyres. The bias and OTR tyre production facility that they have, the manufacturing facility at Limda in Gujarat, has been stopped. This is because of some concerns among shop floor employees related to the renewal of the long-term settlement agreement. So there are some, concerns over there, some disagreements as well. The company is now in discussions and negotiations with the labor union representatives, but the stoppage of production is something that could have a negative sentiment impact. The company, though, in a BSE press release has said that there are plans in place to mitigate any supply disruption. At the moment, there is no material impact on the operations at this stage. But let's not forget that tyre stocks have been doing very well purely because demand has come back in a big way and commodity prices have fallen. So, Morgan Stanley, for example, has an equal weight rating on Apollo Tyres with a target at 425 rupees a share. The other stock to look at is Exide. I'm going with green over there, because what Exide has done is invested an additional 125 crores in the equity share capital in its wholly owned subsidiary Exide Energy Solutions. Exide continues to own 100% stake in Exide Energy Solutions, but now they've invested an additional 125 crores. There won't be any change in the shareholding percentage of the company. And as I said, the shareholding remains unchanged at 100%. But the reason we are putting this on board is because of Exide's increasing presence in this space. Now, EESL, which is Exide Energy Solutions, is in the process of setting up a plant for manufacturing and selling lithium-ion battery cells, modules, and the pack business batteries. The company is a loss-making, business with a loss of almost 60 crores in FY23. However, the fact that Exide is looking to sort of put more money in this renewable energy space is something that the street would like. So I'm going with green there.
All right, Sonia, noted that. So both those two stocks on our radar. But let's wind this down. We have Surbhi who's joining in to run us through some more stocks that are in the news. Surbhi?
Thanks so much for that. So I'm watching out for MCX today. The company has proposed to go live with the new trading platform by the end of this month. Now, a separate circular will be issued where they will disclose the date where they'll go live with the new platform. But as of now, the entire September month, they have been conducting mock trading sessions. Earlier, it was indicated that they will go live with the new trading platform by the end of December. But now they say it will happen by the end of this month. Shri Renuka Sugars, there is a board meet on 23rd of September that is to approve investment in a sugar mill in Uttar Pradesh. This investment will be done through a rights issue. Also, they will consider a fundraise via NCDs. And lastly, Fino payments will also be on our radar. Now, bank has received complaints from clients regarding non-receipt of funds that were invested in a potential fictitious schemes. Now, these schemes were allegedly floated by some of the employees of the bank at a personal capacity. The prima facie investigation indicates that there is no liability or financial impact on the bank as of now.
All right, Surbhi, thanks a lot for that. So those are a whole host of stocks that are in the news. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Sheela Foam, Strides Pharma, Biocon, Exide Industries, MCX and Shri Renuka Sugars. While stocks with negative news flow, there's SJVN, Cipla, Apollo Tyres and Fino Payments. But we would talking about Apollo Tyres, so I just wanted to mention that, although this morning there's negative news flow, a lot of brokerages are very positive on Apollo Tyres, and I think Vivek has, some of that on.
Well, let's hop across to Vivek. Vivek, you have gone through a lot of brokerage notes today. Run us through the list.
Well, absolutely. A couple of key brokerage notes that we are highlighting today. Well, the global agrochem outlook has been quite hazy as far as 2023 is concerned, but some positive news flow coming in today morning. Citi, has come out with a note on UPL. What they have is they have a buy rating on the stock, target at 800 rupees a share. What they are saying is that CY24 onwards, you could see some revival as far as the entire chain is concerned. They're saying that recent data points are quite positive as far as first half of CY24 demand is concerned. They're also saying that the US Department of Agriculture's data points as well as projections are indicating that there could be a pickup in soybean production in LATAM area, as well as what they're saying is that excess channel inventory should get reduced. Along with that, pricing trends as well as Brazil imports data suggest that generic pricing must be bottoming out. Along with that, what gives them comfort on UPL is the fact that valuations at this point of time are quite undemanding at 5.6 times 1 year forward. Now, coming to Apollo Tyres, Morgan Stanley indicates that they have an equal weight rating on the stock, the target at 425 rupees a share. What they're saying is that the tire cost index that at this point of time that they are tracking is actually up almost 7% versus Q1 of FY24. So up 7% on a Q1Q basis. So what they say is that the company would actually require to raise hike prices by close to 4% in order to offset the cost pressures. But what they are cautioning is that the company may not raise prices this time around. This is on the back of the fact that the company would need to focus both on revenue growth as well as market share gains. Company is a strong franchise according to them, but earnings downside risk is what keeps them equal weight at this point of time.
All right, Vivek, thanks very much for that. So that's brokerage calls coming through, and we'll put out more as we go along. But let's turn our attention to all what's happening in the commodity space. Actually, the one respite from overnight is, of course, the slight downtick we've seen in oil prices. Manisha is here with what is top of mind. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, yes, a second straight day when we have seen some profit-taking continue in case of the crude oil prices. So we have come off those 10-month highs and 90 has broken for the WTI prices there. Well, the markets were ripe for some profit-taking. We have been overbought. Remember, the crude oil prices have gained up by 10% in a month and are up 30% in last 3 months. So some profit-taking is what the street is looking at right now. But when you look at the more near-term outlook, most of these banks and brokerages are still quite bullish. There is a latest JP Morgan report that came in yesterday which says that the Brent crude prices could hit $120 a barrel before this year ends on the back of tight supplies going forward. Some profit taking is what we've seen in case of metals as well. Barring iron ore, almost everything has started on a weaker note, while the US has kept rates unchanged, but it has extended high rates timeline, and that seems to be a botheration.
Right, Manisha, thanks a lot for that. So that is the view coming in on the commodity markets. Let's also listen in to Arun Kumar Singh, the chairman and CEO of ONGC, talking about the rise that we've seen in oil prices and the impact it could have.
could be, it is possible that oil may hit 100, but it will not, in my judgment or in my personal opinion, it won't stay there for long. It has to recede for 2-3 reasons. One is right now rally is predicated on the fact that winter preparation, and of course this winter, normally this is the time when September, October, when everybody tries to prepare for winter. And second reason is that this price is not sustainable because of the simple reason that many economies can't sustain this price, and therefore the demand compression will happen the moment it crosses 100. So it may be a temporary phenomenon. I don't see it a permanent thing. Because of the production being from Russian field, it is subject to some sanction, and bringing Russian oil to India has never been a economically possible in the normal times. And even today, this lot of Russian oil is moving to India, and definitely it doesn't make sense still for us to bring too much of oil from Russia to India, particularly a sizable quantity gets sold somewhere else. So that is something that our rights, in fact, of the share of the production remains intact.
Okay, well, that's ONGC saying that they don't really see conditions kind of coming together for a sustained rise in oil prices beyond where we are, beyond 100. If that were to happen, there will certainly be demand compression. We'll take a quick commercial break here. Hemang Jani will be with us for some fundamental stock talk, what he likes in this market, and what's the near-term picture looking like. Stay with us. That conversation in just a bit.
Welcome back. You're tuned into Bazaar Morning Call. Well, if you're looking at the GIFT Nifty and thinking, why exactly is it pulling back to such a large extent? Well, overnight, you got a pause coming in from the Fed. The problem is it's being viewed as a hawkish pause and rates could stay higher for longer. But there are plenty of stocks that will be reacting to news. To help us out with a quick analysis on some of them, we have market expert Hemang Jani who joins us on the show. Hi, Hemang. Good morning. Well, let's talk about SJVN. It had plenty going for it. Yesterday as well, there was some good news that came about. And the government of India, I would think they're doing the smart thing, right? They're taking some money off the table. They've launched an OFS. They priced it at a base price of 15% discount in comparison to yesterday's close. Your view on the stock?
Yeah, good morning, Nigel. So we've seen a very smart pullback across the PSU names, be it power, defense, railway, so on and so forth. And if you look at the movement, some of the stocks have moved up anywhere from 50 to almost about 250%. Now, there is not a corresponding, improvement in the core fundamentals of the company. And typically, we've seen that, the government keeps doing OFS, and that is not, good news for the market, particularly when the stocks have really run up so much. So I think that at these valuations and prices, there is a risk of additional supply coming into, some of the PSU names, be it SJVN or whole host of companies. So it would be prudent to kind of stay away from, the PSU names at this point of time, particularly non-banking.
Hemang, hi, good morning. I wanted your thoughts on how to approach the entire IT sector now, because there's been a bit of a comeback. But, now with sort of the Fed saying that rates will remain higher for longer, we saw a fall in the NASDAQ as well. Do you think the IT sector could take a bit of a backseat? And as a long-term investor, how do you approach it?
I think, Sonia, what we've seen is that the mid-cap IT specific names have done well, be it platform companies or some of the niche companies, Persistent System and LTIM and so on and so forth. But the large cap ones were underperforming. So I think given the recent developments, where in the analyst call, the companies have said that the deal flows continues to be reasonably okay. And we do not see any material risk to the earnings per se. So I think TCS, HCL Tech, these two names do look good. I think midcap is where, because of the way things are unfolding in US, you might see a little bit of a profit booking or, some sort of a correction. But broadly, IT, the large cap name should hold well.
Right. Hemang, hi, good morning. Two names, one stock and another group of stocks. One is HDFC Bank. After yesterday's near 4% cut, what would you do? And second is all these old economy names, right? Power Grid, ONGC, NTPC. These are the names which stood out yesterday. I mean, throw in a Power Grid there as well. So any thoughts here?
Look, clearly, HDFC Bank, I think the analyst call, there were some, concerns about the NIMs, about the growth, at least for the near term. But if you look at the stock, it has actually underperformed big time in the last, let's say, about 1 year or so. And the valuation continues to be reasonably okay at 3.2, 3.4. So I think maybe for, short term, the stock may underperform, but I think it provides a good entry point. Now that we've seen such a sharp cut on a single day, if you see a little bit of weakness, I think it provides a great entry point because the risk reward continues to be favorable. And as far as the PSU names are concerned, as I outlined before, some stocks are doing well. Let's say NTPC, Power Grid. So maybe it has something to do with the certain index rebalancing and the flows expected over there. But in terms of valuations, in terms of risk reward, that space is looking frothy. So I think it would be best to avoid that at this point of time.
All right, Hemang, I wanted to ask you about the platform company, the stock exchanges, actually. You have MCX, they're going to be going live with a new platform by the end of September. You have BSE that's been trying to give a bit of a fight to the NSE, though the NSE is the dominant player. Your view on these, companies, which one would you go in for or would you avoid them?
Nigel, a lot of things are going for exchanges, be it in terms of the volumes, in terms of the new demat accounts being opened, the ADTO on the cash segment. We are seeing a very good traction, coming through. MCX, because of the, technology issues that they had to pay a huge amount of money last couple of quarters. If that stops, surely it's going to be great. BSE, I think this F&O part, where there is a lot of traction, could be a big game changer for them. And I think that there was a buyback also. So I think BSE is one stock, from an exchange participation point of view. Till NSE is listed, people would really want to participate. Even CDSL, for that matter, should see a good amount of action basis the participation by retail into the market.
All right, Hemang, we'll need to take a short commercial break. We'll come back with lots more on the markets and come back with some questions for you as well. On the other side, Anuj will be joining in for a quick trade setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts. Stay tuned.
Okay, welcome back. There's 15 minutes to go for the pre-open session. Anuj is here standing by with how he's looking at the trade setup. Anuj, good morning.
Good morning, Prashant. I'm starting with an interesting image. This is a correlation between the height of the Fed governor and the interest rates in the US. Remember Paul Volcker, at his time, the interest rate had peaked at 16%. Paul Volcker was almost a 7-footer, right? After that, we had Ben Bernanke, then the Aaron Greenspan first, then Ben Bernanke, then Janet Yellen, and the height kept going down and the bond yield kept coming down. The interest rates, of course, were near zero at time of Janet Yellen. And then comes Mr. Powell and he says, okay, let's change things back. Maybe not to the Volcker zone, but at least back to the Ben Bernanke era and maybe even higher. And what was very interesting was, if you heard Powell's commentary yesterday, the moment he started speaking, the market started making big red candles. That was his impact yesterday. It was in the green till then. The markets got what it wanted, basically a pause, hawkish pause. But after that, the commentary that, maybe there will be one more rate hike this year itself. And next year, the cut also perhaps would be much later. So I think all of that led to that big decline in the NASDAQ. And of course, that's something that will have an impact on Indian IT stocks as well today. Because, there will be a bit of a valuation reset. So the Nifty IT, which has gone up about 5.7% this month, that can see some profit taking. Also, yesterday's close was very bad on the Nifty. At no point was there an attempt to even see one green candle, and the market closed at the lowest point of the day. And there's a bit of a triple whammy for the market. The three big stocks, HDFC Bank to begin with, yesterday saw delivery selling of 5,500 crores. The stock was down 4%, the ADR was down 6%. So maybe there's more pain left, and the ADR premium has already collapsed to about 7% now. Reliance, there was no clarity on who sold in that block deal, but the stock was under pressure. And the third big sector, which is IT, could be under pressure, at least in the first half today. Let's see how the second half, shapes out. The Nifty needs to close above 19,792, which is the 20-day exponential moving average, to maintain its uptrend. In terms of levels to watch today, yesterday it was a bad day. So the first level to watch is the 20-day exponential moving average, which is 19,792. And the bigger support lies at the 20-day simple moving average of 19,672. And this is a zone which the bulls have to defend. On the Bank Nifty, we are very close to some big support levels. The 20-day exponential moving average is 45,211. And the 50-day exponential moving average is placed at 44,848. But more than the levels, the way the market collapsed yesterday, while it might have preempted some bit of decline in global market, the close was quite bad yesterday, and today we have the weekly expiry as well. Let's see if in the second half we have some short covering. That could be one hope, given the way the put-call ratio, etc. have collapsed, but that's only a hope right now.
So that chart which you put up, that pictorial graphic, height matters, right? At the end of the day,
Oh, absolutely.
it proves that. But by the way, Jerome Powell's term ends in 2028, so we don't have to worry until then who the next Fed chairman will be.
Where will rates go?
Where will rates go? We are fine for another 4 years.
just try to, make things interesting, trying to find, something. This morning, this picture looked quite interesting to me. And, there's actually quite a correlation between the height and the bond yields and the US interest rates.
Well, President Joe Biden, who he nominates next for, as Fed chairman, that 4 years later, let's see. I hope he's watching this chart as well. All right, Anush, thanks a lot for that and have a good day. We'll speak to you again later. But Hemang Jani is still with us, so we're going to, get a couple of cues out of him. Hemang, yesterday the big talking point, of course, was HDFC Bank and, the bank stating that there will be an impact on the margins, on the net worth because of the merger, right? As a long-term investor in HDFC Bank, what do you do now?
Sonia, before I move to HDFC Bank, to that pictorial graph which was put out, I think we should also put S&P movement along with the height of the Fed chairman, because that will give you slightly more understanding of how the market has behaved even while the rates were going up and down, right? So coming to HDFC Bank, I surely think that the recent analyst meet, there were certain negative takeaways in terms of NIMs, in terms of growth. But what we must understand is that now the valuation of HDFC Bank is almost at about 3.2 adjusted book next year. And with the growth expectations setting a little on the lower side, let's say about 14-15%. So that makes it a little more interesting and attractive from an investment perspective.
Okay, that's on HDFC Bank. Got it. Let me also since it's 8:50, let me also invite Mitesh Thakkar and Sudarshan Sukhani on the channel to give us their views on the technicals of the market. So Hemang, thanks for all your thoughts. Mitesh, good morning. Sudarshan, good morning to you as well. Sudarshan, let me begin with you. What is the view on the index now, given that, things are looking a bit sticky? If there is a downside, the implied opening suggests that there could be a 140-point slide. Would you buy the dip? Would you be cautious? What's the verdict?
Yeah, good morning. Sonia, I would not buy the dip. There are two reasons. One is today is Thursday, and then we have weekly expiry, which creates very unusual activity in options and therefore in the cash index also. And the second is that we have started a correction of some kind. Let this correction stop. Let it find some kind of support, start some base building, then we become adventurous and say, okay, now the dips can be bought because we are finding the markets are giving some signs of support. But a free fall is not a support. So it's not a good idea. It's not a good idea for the Nifty, and it's a bad idea for the bank index, which is likely to see a larger decline than the Nifty.
Okay, all right, stay away. That's a call coming in from Sudarshan. Mitesh, what about you?
Morning, Ajal. Yesterday I was talking about, the fact that we could possibly see some kind of a negative decline, and that could, I think, suggest that a test of 19,900, 850 zone was my first level, and I think we've kind of done that, and I think now I'm looking at the continuation of this decline because a lot of intraday indicators came into some kind of sell mode. So looking at a test of 19,750 on the Nifty, and on the Bank Nifty, the corresponding level is about 45,000. These are important levels, but in case we start breaking below that, and there's certainly a chance of that, then I think I'll be more worried and be aggressive on the shorting side. Till then, I'll still hope that this will play out as some kind of a correction, and then we might regain an uptrend after this correction is over, and then some consolidation takes place. So the levels to watch: 45,000 on the Bank Nifty, 19,750 or 760 on the Nifty.
All right, let's talk about individual stocks as well then. Sudarshan, what's on your list today?
It's a restricted list because it's a very confusing market today, and it's best not to venture in the market or stay as little as possible. Sun Pharma is still a buying opportunity. The stock had a very good day yesterday despite the big decline in the Nifty. And Sonia, you know the pharma stocks do their own thing all the time. So Sun Pharma is a buy with a stop under 1130. SBI Card is an intraday short. If you see the chart, it's falling consistently day after day. It's an intraday short with a stop above 824. And finally, Polycab is a buy. Polycab had a new closing high yesterday, which is very nice considering the market action. So Polycab is a buying opportunity with a stop. Put an appropriate stop in Polycab. I can't give a number because it can open with a lower gap, but put say a 2% stop and then go and buy it as a positional trade.
Okay, Mitesh, what about you? What would you want to trade?
Prashant, like yesterday, I have more of sell calls. JSW Steel was a call yesterday as well. I think there should be more downside left given the way the chart has expanded negatively on the intraday chart on an intraday basis. So 760 is the target over here. 795 is what I would recommend as a stop loss for short trades. A sell on Godrej Properties, which I would recommend selling with a stop at 1620. And a target, slightly positive target of 1525, 1515 can be looked at. Also a sell on Zydus Life. Here I would recommend a stop at 637 and a short-term price target of around 600. And one buy call, that's M&M Finance. Keep a stop below 303 half, and 322, 324 is my target rating.
Okay, thanks a lot for that, gentlemen. Chandan Taparia is also joining in. He's the derivative and technical analyst at Motilal Oswal Financial Services. Chandan, hi, good morning. What are you looking at in terms of trade today? Looks like it's going to be a weak start, but what are the stocks that you're advising our viewers to sort of trade in?
Thank you so much, Sonia. Good morning. So Nifty took pause. Selling pressure is visible in most the indices. Nifty recently made new lifetime high of 20,222, but from last 2 days it is making lower highs, lower lows. Even the mechanical indicators, including RSI, MACD, have given negative crossover. Put call ratio is shifting lower with call writing, which indicates that upside could be kept. Some decline will be there before market start the next leg of rally. So my entire focus will be at 20-day exponential moving average and 50-day exponential moving average that comes near to 19,700 zone. So as of now, till it remains below 20,000 zone, Nifty has potential to retest the key support of 19,700. Talking about Bank Nifty, here also it failed to surpass the lifetime high of 46,369. Made the hurdle, making lower highs, lower lows on the lower time frame. So it can drift towards next support of 44,750 zone. Now looking at the stock wise, a mix of buys and sell, looking at the market scenario. First it is buy on Mahindra and Mahindra Finance, M&M Finance. The stock has given a consolidation breakout of last 18 days. It has given a decisive close above 300. And it is coming out with this consolidation band after a long time. And because of that, some follow-up could emerge. So recommending to buy with support of 299. It can head towards 317 kind of level. Second trading idea, that is buy on Coal India. It has formed a typical pole and flag pattern, which has bullish implication. It is up by around 20% in this series. And now the way it is holding well, short covering could trigger as the stock has really performed well in this series. So expecting further momentum even after the weakness in the broader market. One can buy with support of 278 and upside target will be 295 to 300. One trading idea that is on the sell side is sell on SBI card. This stock has given a breakdown, making lower top, lower bottom. Shorts are being built, which indicate weakness could be there. So one can sell SBI card with a stop loss of 825 and it can drip down to us 777 marks.
Okay, all right, Chandan, thanks very much. Good speaking with you. And it's always a pleasure getting those trading ideas out. We'll take a quick commercial break here. We'll be back. There's 4 minutes to go for the pre-open session. There'll be that to address. And Nitin Agarwal of Motilal Oswal Financial Services will also be joining in to talk about banking. I mean, there's HDFC Bank, there's public sector banks. So what next there? That conversation with Nitin in just a bit.
Welcome back. Let's shift focus now to the banking space. The PSU Bank Index has had a very good run this month. In fact, the index is up 16%. Does this rally have more legs? And of course, to also talk about the HDFC Bank issue that happened yesterday, right? Nitin Agarwal, Senior Group Vice President, Head BFSI Institutional Equities at Motilal Oswal Financial Services is with us. Nitin, hi, good morning and thanks a lot for joining in. First, I want your thoughts on HDFC Bank because, it fell 4% yesterday. Of course, there are concerns about the merger, but I understand that these are transient issues that would happen, had such a big merger taken place. So do you think for a long-term investor, one should not be too perturbed, or would you be cautious now on HDFC Bank?
Yeah, hi, good morning, Sonia. So yes, HDFC Bank, what the investors are getting to know now is the baseline, and what the management therefore talked about as to how the numbers will look like, especially in context to margins, net worth, and that baseline has receded a bit versus what we thought it out to be, and which has led to a downgrade across the street in terms of the numbers. But we cannot really question the investment thesis in the stock for a long-term investor particularly, because we are still getting the visibility of the bank reaching up to 2% ROA by FY26. So it's going to be a gradual improvement in earnings, and probably 2Q now will be a weak quarter to start on the merged entity. But thereafter, as the liquidity gets deployed, the business growth will be one big monitorable over the coming quarters. As the execution therefore remains on track in the coming quarters, you can see the stock delivering at least returns in line with the ROE to begin with, and see some re-rating thereafter. But the next 3-4 months, the stock I think can remain in a range till the time you get clarity on that and the execution picks up.
All right. Hi, Nitin. Good morning. Nigel on this side. Nitin, we have seen HDFC Bank traded far higher multiples on a price-to-book basis. I think currently it's at around 2.6, 2.7 odd. In the past, where has it bottomed out? I mean, at what level has it bottomed out in the past? Because 2.6 times for a size of the bank like this is fairly attractive, right?
Yeah, I agree with Nigel. And if you look back, if you look at the forward multiple, the stock is somewhere around 2.1 times price to book on March 25. I'm talking about, and which is very close to the bottom valuations, barring the COVID lows. And otherwise, if you look back last 10-15 year history, the bank is pretty much close to that, and which is why we feel like that with a visibility of 2% ROA and 16-17 ROE that you will likely be at by FY25 and 26. We should not see any big derating in the stock. But after this merger now, and with the entity becoming much larger in size, the execution on the business growth front is going to be very critical, and wherein the deposits is going to be the first key metric that investors will be watching out, because we had a very strong run in 4Q, and then 1Q was a slightly softer quarter. And going forward, while the competition will remain very tight, but the performance of the bank on deposits, and thereafter even the advances, because you are right now talking both on the core basis growth and the merged entity growth, I think that has to sometime go away as you progress in the coming quarters. And the merged entity will be looked at as to how it is doing in terms of growth, and thereafter the margin. So all these key metrics will be important to look at. And as they deliver on the expected lines, you can expect the stock to re-rate. But in terms of absolute downside, I think that will still be limited when you look at it on a 6-month basis, barring this now the negativity that has come in post the recent disclosures.
So absolute downside limited, but absolute upside also. I mean, it'll take time, basically, right? And that's what you're saying. It's not going to happen immediately. Just a quick word, since we have you this morning, and we're just coming off the back of this Fed meeting overnight. And the message seems to be, rates perhaps will be higher for longer. What is the impact on cost of funding according to you here in the Indian scenario? Because what happens in the US will have an impact on what the RBI will also do. In that sense, should we expect some more NIM compression across the board for the rest of the year, FY24? What are you building in? Not for HDFC Bank, but for stocks under your coverage.
Yeah, sure. So I think we are not looking at any more rate hike as of now from RBI. And while the rates may remain elevated, so the turn in the rate cycle may get deferred a bit, and which is where the deposit rates and the cost therefore may continue to move up, and probably it may take one more quarter before we see a turn in the funding cost. And therein, I think private banks, therefore, especially the larger ones, will continue to see a compression in margins over 2Q and 3Q, and possibly by 4Q you will see some stability in margins coming through. But then thereafter it will again be a function of as to how quickly RBI acts on the rate cycle. If the rate cut happens for any reason to be faster than what market is thinking right now, then there could again be a compression in margins in FY25 again, which we are watchful of. PSUs in this regard may do slightly better because they have a larger proportion of MCLR book, and therefore the funding cost may peak out by 3Q, and given that alongside you will also benefit from the MCLR repricing, and therefore the NIMs can actually do better by 4Q for them.
One follow-up, you said HDFC Bank is trading at 2.1 times price to book currently, right? Which is the lower end of the historic valuations. Is that correct?
Yeah, on adjusted basis, adjusted for SOTPs.
Okay. And so from a long-term standpoint, if you had to give us your pecking order, right, in the private sector banks, what would it look like? Would HDFC Bank top the list? And what next? I mean, between both private and PSU.
So we, from within the private banks, we have been pushing for ICICI Bank and IndusInd Bank as the two top ideas in the sector. And while HDFC Bank also looks good to us, but it's just that for the next one quarter, I may take a breather, and you will want to watch out as to how things progress, because this entire liquidity built-up that happened at HDFC Limited was towards the end of the quarter. And you will want to see as to how quickly it can get deployed. Though there are some positivities in terms of the rollback of ICRR, that will help margins to some extent, and also the deployment that will happen. But alongside, because you will also be looking to raise more and more term deposits. So the funding cost, therefore, the benefit that one was looking at in terms of the repricing of borrowings from HDFC Limited down to HDFC Bank cost is not going to happen anytime soon. And which is where the margin improvement will take a lot of time to come back to where it was pre-merger. But from the operating performance overall, now that you have already found a bottom close to that in the second quarter, I think things will only move up gradually. Which is where the re-rating probably will happen in 12 to 18 months.
Nitin, on an absolute return basis, what are your top ideas across your coverage universe? Top three ideas?
So, see, within private, we will say ICICI Bank and IndusInd Bank, these two ideas. And within PSUs, we like SBI, Bob and Canara. So between these three, depending on as to what and how much down the curve you want to go in the PSU bank, we can look at alpha idea. I think only from alpha angle, probably Canara Bank looks relatively cheaper because there has been a good momentum in the PSU bank, and we did one report on them a couple of quarters back. And from a time wherein one was not very sure of these banks' ability to sustain 1% ROA, today many of them are looking to beat that number in the FY24 itself. And which is where I think the re-rating in these banks will continue, and Canara being cheaper looks to be a good bet in the PSU bank.
All right, Nitin, thanks so much for stopping by and giving us your views on the PSU banking space. Canara Bank is looking up. HDFC Bank, well, at around 2.1 times odd. That seems to be a bit of a bottom in terms of a price-to-book multiple. Appreciate you joining in, Nitin, and giving us your view. But it's 9:10, so let's get in our technical experts back with us. So, Darshan, what's your 9:10 call?
Sun Pharma is a buy with a stop under 1130.
And Mitesh, what about you?
I'll go to the sell on Brokerage properties. Keep a stop about 1620 and 1530, 1520 is the target zone.
Yes, sell on Godrej properties. Okay, got that. Well, looks like it's going to be a slightly weak opening, but let's head to Nimesh. He's going to give us the standout brokerage report of the day. Nimesh, over to you.
Hi, morning, Sonia. So today's standout is on cement sector. A contra view from Bernstein. Today they have downgraded few names, which include Sri Cement. They've downgraded to underperform now, and there they've got the target pursuit 22,341. They've also downgraded Ambuja Cement and Ultratech Cement. For Ambuja Cement, the new target price is 424. And on Ultratech Cement, they've got the target pursuit 20 to 56 with a neutral rating. Now, the key reason for the downgrade, one, they believe that most of the positive news are done, and post their updated view on coal, they've cut the EBITDA per ton estimates for most of the cement names by 4 to 8%. They believe that there is no reason for further valuation re-rating from current levels. And also, after 2 quarters of numbers, they see limited improvement in the EBITDA per ton as well. So, on back of this, a contra view on cement sector, with a downgrade on Sri Cement, Ultratech, as well as on Ambuja Cement.
Okay, thanks a lot for that. Well, Ekta is with us to give us the momentumizer stock of the day today. Ekta, what are you looking at?
For that, well, I'm looking at one of the hospital stocks, considering that a lot of the hospital stocks have shown a lot of momentum of late. So Fortis, for example, was up 3.4% in yesterday's trading session. It's a part of the S&P BSE 500. The stock has rallied around 37% from its 52-week low and just about 5% away from its 52-week high of around 337 odd rupees. Now, the hospital space, like I mentioned, continues to see momentum. We saw good listings coming in from the likes of Yatharth as well as Jupiter Lifeline Hospitals. Separately, there is a lot of interest in terms of funding of the hospital space as well. For example, TPG-backed Asia Healthcare has acquired over 70% stake in Asian Institute of Nephrology and Urology for around 600 odd crores. This just happened yesterday. And now we have Manipal Hospitals, which has bought around 84% stake in Imami Group AMRI Hospitals for around 2,400 odd crores. So that gives you a sense in terms of the overall interest within this space. When it comes to Fortis's valuations, it still has a way to go to compete with the big wigs such as Apollo. So Fortis is trading at around 17 to 18 times FY25 estimated EV to EBITDA, Apollo at around 24 to 25 times, but Fortis is more expensive than the likes of HCG, which is around 14 to 15 times.
Right, Ekta, thanks a lot for that. Well, SJVN in pre-opening is down almost 9%. Let's find out why. Vivek is here to tell us. Vivek.
Well, absolutely. There is an overhang of almost a 4.92% stake sale by the government via the OFS route. So the OFS has been announced. The base size is 2.46% and the oversubscription is another 2.46% that the government can choose to exercise. Why is the stock down? The floor price for this particular OFS is at 69 rupees a share, which is almost a 15.5% discount to yesterday's closing price. So, the government at the end of the June quarter held close to 60% stake, 59.9% to be precise. Now, along with that, also you need to keep in mind the stock has had a stellar rally like we highlighted yesterday as well. The stock is up 151% in the last year and is up 100%, has doubled from June 2023 low. One of the reasons, for the strong up move by the stock has been the fact that the company has alluded to the fact that they've gone ahead and increased their guidance as far as capacity addition is concerned to 7.7 gigawatts by FY26, versus earlier what they had in mind was 2.7 gigawatts by FY25. Stock has been a strong outperformer. This OFS continues to remain as a technical overhang.
Before the market opens, let's also talk about Apollo Tyres. That stock is under pressure right now. Its production facility in Gujarat, in Limda in Gujarat, has been halted. This is a production facility where they produce bias as well as OTR tyres. Now it's been stopped because there are some concerns about that shop floor employees have related to the renewal of the long-term contract. So basically it's a labour union issue and the company has been in discussions and negotiations with labour union representatives. As of now, they've said that there is a plan in place to mitigate any kind of supply disruptions. There's no material impact on operations at this stage. And, a couple of brokerages continue to be bullish on the stock in the longer term because demand has improved as well as, raw material costs are lower. So Morgan Stanley has an equal weight rating with a target at 425 rupees a share. So Apollo Tyres under some pressure over there. But I think we have less than a minute for the markets to open. Okay, just 40 seconds for the markets to open. Looks like it's going to be a weak opening today. So just take a look at the headline index. As we've been telling you, the Fed has come out and said that the rates could be higher for longer. So it will be very data dependent and they will hike rates if required. And that I think has spooked most global markets and for our own markets as well. Things could look a bit cautious today. The only good part is, not a good part, but we perhaps saw a large part of that sell-off yesterday as well. So let's see if the damage is limited today. But for now, looks like the Nifty could escape with a 60-point cut. At least that's what the GIFT Nifty is suggesting. Cases in point, technology stocks perhaps could be under pressure. HDFC Bank was the big loser yesterday. Let's see how that goes out today. And, banking, metals, realty, we've seen some pressure there. But here's the first tick that we're getting on the index this morning. It's down about 78 points, actually quite a weak start. The sensex is down about 300 points as well. So not looking that great. The Bank Nifty is down about 230 odd points. So we've started on the back foot for the index. HDFC Bank, after a 4% cut yesterday, is down an additional 1.5%. And as I said, the IT sector has taken a back seat today. So HCL Tech, TCS are all under pressure, down about 0.5 to 1.5%. Reliance has been dragging its feet for the last many days. So that stock as well is down 1%. And then you have names like ICICI Bank, Bajaj Finserv, NTPC, Tata Consumer Products that are under pressure. But the the pressure on HDFC Bank is felt hard now. So it's almost a 6% knock in the last 2 trading sessions and not looking good at all. Just hovering around that 1,500 rupee mark on HDFC Bank. On the upside, what's batting for the bulls this morning is autos. M&M, Tata Motors are in the green. Pharma is doing well. Dr. Reddy's is holding up. You have Axis Bank, that's not bad. It's been outperforming a bit. Bharti Airtel, SBI, SBI Life, Bajaj Finserv, and Britannia, Titan. Some of the consumption-oriented names are not too bad. Now the damage is being restricted to about a 60-point cut. So the Nifty holding on to 19,800. But the run-up has been so fast and so ferocious that some amount of profit-taking perhaps won't harm anyone. Now down about 70 points.
Well, that's right. Suraj, just one point on HDFC Bank. It broke the 20 DMA yesterday. And as of now, it's on the verge of breaking the 200 DMA as well. It just broke the 200 DMA actually. 200 DMA is at around 1,550 approximately. So HDFC Bank, if it needs to bounce, it needs to bounce from somewhere on these levels. Not just the fundamentals, but other technical factors as well are playing out. It's intraday breach, the 200 DMA, so keep an eye out on that stock. But the stock that's flying away from the broader markets, don't lose sight of that, is MCX. They're going to be going live with their new platform by the end of September. So MCX is a stock that's up close to around 5% as we speak. Keep an eye out on that one, 4% now. Apollo Tyres on the flip side, well, there were some concerns at their Gujarat facility with regard to the shop floor employees relating to renewal of long-term settlement agreement. They are in conversation, but for the time being, that stock's open up on the back foot. A couple of other stocks that are losing out. GMR Power, remember the stock went one way from around 25 rupees to around 45 rupees. They had a lot of, the smart meter order wins that they saw. I think in a matter of 45 days, it went up by such a large extent. From yesterday's high, the stock has lost close to around 20% of its market capitalization. SJVN as well, since we have an OFS that's priced at a discount of close to around 15% in comparison to yesterday's close. That stock as well is down 8.5%. And NMDC Steel as well had a good run. Well, that stock as well has pulled back close to around 2%. Prashant, what else?
Sirma is one stock I can pick up with a large gain. It's up 7%. Actually, there is, I think, Morgan Stanley, Sirma and Keynes. So the EMS companies, Morgan Stanley basically has initiated coverage, I think, on these two names this morning. 555 on Sirma, and I think Keynes also I saw early on. It was coming with some amount of gains. 555 on Sirma. There you go. On large volumes, mind you, for this time of the day. And maybe just take a quick look at Keynes as well. More and more brokerages have initiated coverage over the last couple of months on this entire EMS opportunity, although there are still a few who don't have coverage here. So Keynes is the other one, which is buzzing. What else? I mean, Tarson's is a stock we highlighted, yesterday as well. Again, a fairly recent listing, 4% higher, 550 on Tarson's, as a medical devices company. We've got Jupiter Wagons, which is coming up with about a 1.5% pop. JM Financial is up about 1.6%, but it's a little sort of, all over the place. It's not, there's no real kind of one-way move in any sector at all. Maybe I can spot 2 or 3 PSU banks which are doing well as a whole, IOB and UCO Bank and a few others, but that's it. Otherwise, very dispersed kind of move is what we have at this point in time. On the downside, market breadth, by the way, is positive, but by just a little bit. 100 stocks separate gainers and losers in favor of gainers. Apollo Tyres, Sonia highlighted earlier, 2.25% lower on Apollo Tyres. KPIT is down about 3%. These are some of the more prominent losers on the back of volumes. Bombay Stock Exchange was down about 5% yesterday. It's down another 1%. Just pull back after the, again, one-way move we've seen in this name. Blue Star had a very large move yesterday. That is down about 2%, just under 890 or so. There is NMDC, Chennai Petro, Petronet, Indian Hotels, India Cements, all down between 1.5% to 2% or so on the back of decent-sized volumes right at the word go. So just a bit of color on what's going on. We're down 80 points, 19,819 on the Nifty at this point in time. Ajay Srivastava is our market master of the day. He's CEO, Dimensions Corporate Finance Services. Ajay, it's always a pleasure having you with us here on CNBC-TV18. Thanks very much for your time. We're coming off this Fed meeting from overnight, and I'm sure you've kind of paid attention to what they've said, and a lot of opinion about whether this means this is bullish or bad news, because what they're essentially saying that the economy is just strong and we don't see the need for big rate cuts or something next year. So it can be read either ways, and the market kind of flits between reading it one way in certain phases and reading it the other way in others. And I wonder in which phase we are in right now. Is it good that there is good news, or is it bad that there is good news? Go on.
Well, okay, I don't know. Now the conundrum is it bad if it's a good news or a good news for bad news? All right, so I can't decipher that. All I know is high interest rate in the US don't do well for India at all. And I think in multiple levels, one, Indian interest rates have to remain much higher. There's a pressure on rupee which will keep coming into place. And the fact that interest rates are high in the US mean that they are low on unemployment at that point of time, and which is what is true. They're one of the lowest historical unemployment rates compared to Indian situation. So I think by and large, I think there's a consensus, at least for Indian markets, that high US interest rates don't work for us. And it was some kind of bad news that at the end of the day, they might keep the rates higher at 2024. Because for India, the challenge is the differential between Indian rupee rate and the Fed rate has now become the lowest, I think, since I've known about it. And I think if that starts to kind of hurt India's flows and capital and currency, then India will have to perforce increase interest rates. So the sang-froid shown by RBI not increasing the interest rate, I think could be quite short-lived if you ask me, given inflation where it is going. And US has given a very clear signal, Fed, that we're going to keep it up. So all in all, I don't think high interest rate, whether good news for economy or bad, is good for Indian market. It is not good for Indian markets and Indian investors.
Okay, high interest rates not good for Indian markets and investors. Ajay, how are you feeling about the markets now at these levels?
Good. Hi, Sonia. I am feeling good about the stocks I own. That's all. Market levels, I love the market level volatility because that what makes my guys some money at the end of the day. And also, fundamentally, it aligns the market with what's happening in the economic fundamentals. So I am feeling very good to the correction in the market. We done recently well where we positioned vis-a-vis the Nifty. But I still think that it's a little more way to go to come in sync with what's the economic fundamental. And Sonia, I want to bring you the point that what a landmark data came out yesterday. India is sitting on net household savings 50-year low, which tells you what is the firepower Indian consumer has to buy without resorting to money, credit. And I think that's the one data point which every investor should keep in mind, that do people have enough money without borrowing to buy what we think is going to be a great consumption story. Sobering thought, but keep it in mind. That's going to affect your portfolio for the next couple of years.
Hi, Ajay. Good morning. Ajay,
Good morning.
The big stock that everyone's been talking about is HDFC Bank. One would have thought it's getting attractive at these levels. But what's your view? Do you think there is still some more pain? You would rather wait by than jump in?
My view is what came on a channel on the day the merger was announced is going to be a very expensive bailout of HDFC Limited by HDFC Bank shareholders. And it is proving to be so. What they did not tell the shareholders was how much is going to be the cost of the bailout. Yesterday it came out, net worth right about 20,000 crore. What more will come? We don't know the answer. I think HDFC Bank shareholders got a really rough ride. They didn't need the company. Now they've got this company. They got a cut in the net worth of 20,000 crore, which makes it basically about 1,500,000 crores of loans they cannot give anymore. I don't know why you want to be a HDFC Bank shareholder at this point of time. They had a good run and a monopoly status. I don't think in the next couple of years they will give you superior returns to the market or even the banking industry. I think it's really the last stock you should pick up, in my view, compared to what's happening in other banks. They're growing better. They're doing better. There's more transparency. I think it's certainly a stock we don't own it anymore, and it's certainly a stock we don't intend to own at all. And I won't, I don't do stock recommendation, but you'll be a hard optimist to kind of think that that bank is going to give you returns superior to other banks or the market. So I think just let it be. It was a heyday. It's gone. It's over. It's like the heroes in prime, Indian movies. He's gone and over. We're done with. Forget him.
Indian heroes and
Shah Rukh and Sunny
But have come back, yeah.
They're coming back in style.
I was thinking of Anil Kapoor, but that is also...
Ajay, where are you? The Indian heroes of the last 30 years are back in action. They're making the biggest blockbusters even today.
Sonia, you said it, back in action. So give them a break. They will realize where they went wrong. They will come back to you. So wait for it. Let them do the same story as what Shah Rukh has done, etc. So wait it out. They will come back. I'm not saying not come back. but give them time. They're like Indian heroes. They may come back or they may never come back. And I am in the mood that...
So who are the heroes
Okay.
of the next 1 to 2 years? Tell us that. That's more important, right?
Oh my gosh, 1 to 2 years heroes. Real life heroes are you talking about? Or is we going to have
stock market.
elections?
Stock market heroes. What we are more
I
interested
tell you, I tell you, it's no rocket science at the end of the day. India has got three spending stories: railways, defense, infrastructure. Those three stories are what is going to play out for Indian investors because these are the kind of contracts which run for multiple years. It's not like you don't buy toothpaste or you buy a new TV. But if you get in a project of a railway security or you get in a project for railway, modernization, these are 5-10 year projects and they give you enormous income on maintenance, services, spares, etc. So I would still say railways and particularly MNCs which deal with railways, I think those are best places. Railway security, which is the protection, which is your coverage kind of stuff companies. Defense certainly is going to have a beautiful run, and the infrastructure companies are going to make hay because these contracts are going to run for 5 years. Anything related to consumption, I think wait for a while. Let the Diwali season play out and see how good or bad it's going to be. There is euphoria on consumption. I would temper it down given what the data from RBI told us yesterday.
Ajay, actually, I wanted to come back to that. So you said that's a sobering thought, but and you said it has implications for your portfolio, right? That I'm talking about the household savings data which came out. So how are you looking at it? Because you began by saying, well, it shows you what consumers can do without resorting to credit. But that also means that savings have been depleted to a very large degree.
So what we have done, right or wrong, we have done is our NBFC portfolio is zero at this point of time. There's zero allocation to NBFC sector. We have none in the stock portfolio at this point of time. We have none in the retailing story at this point of time. We've taken everything out of the retailing story. There's none in the apparels kind of businesses, absolute zero allocations to that part of the story. So I think those we have taken away from the table, a lot of the stuff out of it, and we've relocated it back to the sector that we spoke about. And I think fundamentally that would give a better return in this market because given the way oil prices are today and the government needs to hold it at this point of time for given the election compulsions, somewhere, etc., the taxes will have to go up at this point of time. I do not know whether they'll allow oil prices to go up in retail or they will put in more taxes. Whichever way it works is going to hurt consumption. So I think consumption plays, except the high-end consumption plays, which is the 5-star hotel companies, the airlines, which we are holding off. But everything related to economy and sub-economy, retailing, general retailing, I think we've gone zero. NBFC, we've gone zero. And we're going to play out with the segment of, as I told you, infrastructure, railways, and defense.
Okay, all right. Well, Ajay, we'll leave it there. Thank you very much for joining us. And it's a pleasure.
You enjoy the weekend blockbusters, my friend.
Yeah, I will, Ajay. It's always a pleasure speaking with you. You are one of our heroes. I mean, and I've been, I think, speaking to you at least for the last decade and a half. So, that I guess counts as well. Okay, now let's talk about a company which is also an exchange, right? I mean, we don't do that very often. I'm talking about Bombay Stock Exchange, which is on our radar. The equity derivative volumes have picked up quite a bit there, and growth has been better in that segment, especially equity options than what most expected. In other news, BSE has also revised their buyback price to 1,080 rupees from 816 rupees per share earlier. We have the Managing Director and CEO of the business of the company joining us. Mr. Sundaram Ramamurthy is MD and CEO at BSE. He's with us here, by the way, in our studios. Mr. Ramamurthy, it's great to have you with us here.
Good morning.
Really pleasure that you could make it to our studios, sir. I mean, the business is doing good. It's reflected in the stock price in a very large way as well. But if you can talk a little specific, especially since options are the largest part of our markets now. What are BSE's plans? I think the last data we have suggests that you've reached about 5% share in the equity options segment. What's the latest number? What's the internal thinking on that in this particular segment? Where do you want to be?
First of all, thanks to CNBC for this opportunity. As you are aware, on May 16th, 2023 to be precise, we introduced sensex derivatives in BSE. Rather, we relaunched sensex 30 derivatives. We started with around 8 members being fully ready, totally 28 members participating. In 16 weeks, as you rightly pointed out, much far exceeding our own expectations. The product has grown, and last couple of weeks, 2 weeks, if you look at it, we are doing around 100 lakh crores as notional. Around 300 members have already been in, and when we started, 2 software providers were supporting us. Today, around 13 software providers are supporting in the front end. Around 5 crore UCCs have gotten in, and around 3 lakh UCCs are regularly trading. Quite a few things have developed. If you take the average daily traded volume, which is a mix of all the days and then average out, as you rightly said, it is 5% in terms of the total turnover notional, and around 1.5% in terms of premium. Any new contract in India, the trend is the volumes are seen more on the expiry day. I initially thought, honestly, it is only in India. Yesterday I was just browsing the websites to see what's happening in S&P 500 index options in US. Believe me, on the 0 day to expiry options, as they call it, the volume is 400% of what it normally trades on the other day. So probably this appears to be a trend, and slowly it spreads to the other days. So on the expiry day, if you compare sensex volumes to a comparable index, say Nifty volumes on that day, because that's not the expiry, we do around 60% plus. On
60% of
Nifty.
So on Friday, on the expiry day for you,
my volume is around
60% of what Nifty does on Thursday.
Nifty does on Friday.
On Friday, okay.
That's not apple to apple comparison.
Okay.
So you compare it with Thursday expiry
Correct.
Nifty, then it's around 30%.
Around 30%.
So this is where it is, and this is where it is
That 5%
growing.
number, Mr. Ramamurthy, where do you want to, what can you get to in terms of notional volumes as a share?
Let me be very honest with you. I don't have any such number target. Let me tell you what is the target I have in mind. That is where actually I started from in my career here. The entire purpose of me coming to BSE was to make it vibrant and provide such products which are alternates available to the market for them to trade in a viable way. So that is the only intention with which we have started this journey. And if we take it forward in respect of equity derivatives, what I would like to put as a number here is, if I have 5 crore UCCs with me in that, at least 20-25 lakh UCCs should regularly trade. If there are 800 members, at least 400 to 450 members should regularly trade. I am having around 300 members. That number should go up. So if this is and I should have at least a significant volumes coming from foreign participants, because then only the good word of India spreads everywhere.
Absolutely.
So this is what I am looking at. I'm not looking and putting a number to what is the volume I should do and what is the premium I should do, what is the money I should earn. That's not what I am looking at. Because the primary purpose with which we have started this journey is to make BSE vibrant.
Absolutely. Mr. Ramamurthy, it's a pleasure having you here in the studio. Thank you for joining us. In the equity cash segment as well, I want to understand what is the potential now, given that, there's so much growth in the markets. Your market share in the equity cash segment, I think, stands at about 9% as of September this year. Correct me if I'm wrong. And what is the kind of opportunity you see? Any targets that you have in mind at all?
So there I had put myself a specific target. When I started the journey, I should have at least 10% market share with me. I'll tell you where this magic number 10% is coming from. 2014, I left this industry and went to Bank of America as MD and CEO. Honestly, I never thought I'll be coming back to the capital markets, but as it is, I am here. So when I left, the market share of BSE used to be a significant 30+%. When I came back, I found it was around 5 to 5.5%. So there has been a significant deterioration in the market share. A lot of reasons I was able to see which were contributing from every side, from retail brokers, and if you look at it, intraday interoperability, which allows the margin offset for a client if he trades in one exchange and sells in another one. So that was not being provided by many brokers. We talked to many of them, and they are all in the process of implementing it now. Some of them have implemented. It is regulatorily provided. It is just the broker front end has to provide for it. And in terms of institutions, I get 4% of the total volumes from mutual funds and insurance companies. When we approached them, they were telling us that you don't have much liquidity. My humble request to them was, you place no market orders, you place limit orders. So please place the orders, because what happens is then the market participants see that there are big orders available. Then they swamp in to fill your orders. Then liquidity automatically gets generated. It's a long journey with regard to institutions because they take time to imbibe. So we are working on it.
But you know, this 10% target that you have is something that you've almost met. I mean, you're 9% in August. So I'm just trying to understand, what is the scope over the next 1 to 2 years? How much can you take it to? And where else do the gaps lie that you would like to fill?
Oh, yeah. So the gaps were mainly coming from all participants, as I just talked about, retail and then institutions. FPIs are not able to trade in BSE, not that they don't want to. Their requirement is a single contract note with a single VWAP price across exchanges. So that probably they feel is not yet provided for. So we are working with the market participants to get that provided. That will fill in that gap. And then is HFTs. If all HFTs try to look into an exchange when they are able to trade derivatives. If you do not have derivatives, they don't put in all the paraphernalia of things required as infrastructure to trade. So now that you have that, you find the ecosystem is getting built. That's why probably you are seeing inch by inch we are moving up. So once it touches 10%, some of the SORs will start working differently. Some of the HFTs will start working differently. So I feel the share will go, market share will go up. My feeling, which has been vindicated till now, is that any market share growth of BSE will not be at the cost of other exchanges' volume traded. The market share will come, but the volumes will continue to increase because of two reasons. The country in itself is going on a very big growth path. And second is, when HFTs trade in one exchange, they provide liquidity there and they square off their positions or take contrary positions in the other exchange by way of both active and passive strategies. So the pie increases and I will have a market share. It's not that the pie will be same or it will shrink and I'll have a market share.
Okay.
If I have to put a number to what it is anybody's guess. I feel the trend continues in 1 or 2 or 3 years' time. It should be a decent 10-20%, from 10 to 20% over a period of 2 to 3 years' time. Because now if institutions start pumping even 10% of their activity to me,
okay,
and if HFTs find that attractive,
yes,
then the amount of volume traded by HFTs increase and retailers find it easier to find a better price, finer finer bid-ask spread, and therefore better liquidity.
Okay, all right. Good morning, Mr. Ramamurthy, and good to meet you after many, many years. I think when I started my career at NSE, I'd come to you for a couple of files at that time. So good to meet you after more than 10 years. And kudos to you in terms of the progress you've seen at BSE. We've discussed the operational performance. I wanted to understand whether you're looking at unlocking any more value. The BSE Star MF, that's been a star product, right? Gaining market share out there. The street would like to know whether you have any plans to unlock value there. So that's the first part. And the second part is you've sold some stake in CDSL. Any plans to further monetize some stake out there? Go ahead, sir.
So value is a term which means different for different people, right? I'll tell you what it means to me and how I plan to unlock it. Last 2 years, when I look at it, the UCCs in BSE has grown by 9 crores, which is not a small number. So totally today I have 14 crore UCCs with me.
Unique client, unique clients, right?
So unique client code does not mean they are unique clients in the sense that some of them can have joint PAN and all that stuff. So at least if I use a single denominator to measure it, 9 crore UCC has come in the last 2 years. There has been a good amount of penetration into the market, to say so, in terms of mutual fund volumes. For me, unlocking the volume is further penetration. To provide a very stable platform where product, features, functionalities, control, governance, sustainability, scalability are provided.
Right. You know, Mr. Ramamurthy, I get what you're saying. You're looking to further penetrate into the market and further expand. So we get that. You know, my question is, from a shareholder's perspective, they want to know whether you're going to unlock value. In that sense, will you look at getting a financial investor? Could you look at listing this platform? You know, those are ways that a shareholder perspective would be looking at. So that's the first part. Is that a plan? And second part is on CDSL stake. Will you sell some stake?
So let me answer the second one
Yes.
first. CDSL stake, we sold 5% because
Correct.
it was a regulatory requirement. The remaining 15% we are permitted to have it, and we don't have any plans as of now to sell that off.
Got it.
Because it's a strategic investment for the country's need, which we entered into regulatory requirements, so we sold the 5%.
Correct.
The first one, mutual fund platform is not a standalone platform. The license for us to do that is come to us because we are an exchange. And exchange is already listed. So anything we do as value add in terms of penetration is actually giving money to the shareholder back.
So it's already listed basically under
Yeah,
BSE.
it's
as
part of the BSE. Yeah.
Just one question, Mr. Ramurthy. There was a note from IIFL, and they pointed out that you currently charge 500 rupees per crore of premium turnover, which is actually a fraction of what the NSE charges. NSE on an average, I think, is about 3,000 rupees or so. And they said, well, they expect BSE will increase this shortly. Should we expect this, and by how much?
See, this 500 rupees is not by my design. It is one another legacy which I had inherited. This was the number which was there in the system when I have joined. And 8 months is too short a time to look at everything and arrive at the right thing. So, will I start charging some meaningful number for derivatives? I put the question that way. Yes, at the appropriate time, at the appropriate level, I will be charging.
This year in FY24?
Honestly, I don't know. I need to ensure the timing is appropriate.
Sure.
What I would mean by that is volumes on a sustainable basis daily with a greater penetration of the market where you feel the product has started flying on its own.
So at about what market share will you,
I will not
roughly
be looking at it, as I told you, I'm not looking at it from a market
and what
share.
is an appropriate number from 500? What is the correct number?
I honestly don't know. I will be going to the market and discuss this. Whatever I do will be after consulting the market participants.
Okay, just one quick question before we let you go. We're running out of time, but not out of questions. You have some other businesses which are in a very nascent stage, right? Whether it's the power exchange, whether it is the insurance distribution, Gift City, the international exchange, etc. Any plans that we can, expect to sort of fructify over the next 1 year?
You should. There will be plans. It is just that in 8 months' time, I did not have too much of time to devote to all this. You have pointed out all the right places where I should be devoting more time. I will be doing them, and there will be plans, and we will be doing whatever best we can within the regulatory ambit to further those businesses.
Okay, all right, Mr. Ramamurthy, thank you so much for coming here to the studio and answering all of our questions.
My
and all the
pleasure.
best.
Thank you
with
so
your
much.
plans.
Thank you.
Well, okay, so that is the word coming in from BSE. A lot of important takeaways coming in from there. But let's do one thing. Let's take a quick commercial break. On the other side of the break, how are the festive season demand trends shaping up? Shashank Srivastava, the Executive Officer, Marketing and Sales at Maruti Suzuki, will be joining in for an exclusive conversation. Stay tuned. Later, we'll also be joined by Deepak Goel, the Director Operations and Group CFO at APL Apollo Tubes, to discuss their business outlook. Stay tuned. Welcome back. This is Corporate Radar. On to an exclusive conversation now. Maruti is on our radar today. The stock is buzzing. It's at a 52-week high. The stock has also had a big rally this year. Shashank Srivastava, the Senior Executive Officer, Marketing and Sales at Maruti Suzuki, joins us now. Shashank, thanks a lot for joining us. First, if we can just, set the tone with some indication of how the demand trends are panning out this festive season.
Yes, so the demand trends are actually quite positive. So as you know, the festive season begins in India from the 17th of August in Kerala. That's the Chingam month there. The Onam was on the 29th of August. And there we saw an uptick of almost 24% in retail. That's a really positive beginning. That sets out some sort of an indication for the other months of the festive season. So right now we have the Ganesh Chaturthi and the Janmashtami festival going on, and we have seen an uptick of almost 8% there. So overall things looks positive. September, again, 5% up in inquiries, retail's up 36%. And therefore looks like quite positive season this year as well.
Okay, so you said there is an uptick of 8% in retail sales in Ganesh Chaturthi and Janmashtami so far, and you saw 24% uptick in retail sales during the Onam season. So what does this mean for overall monthly sales? Because in August, you outperformed the industry with the wholesales going up about 15%. You're sitting on a base of around 1.9 lakh units. Is that a sustainable trend in September and October?
I think volumes, I can't comment individually on Maruti Suzuki, but I think industry volume should be roughly similar to what you saw in August. That's around 360,000. Last year, of course, September was the peak month, highest ever in the history of Indian auto industry. That was 355,000. So we can expect very large volume this month as well. I think this should be the highest ever monthly sale in the Indian auto industry in September on a wholesale basis. But on the growth front, you will still find just about a 1.5 or 1.5 to 1.7% growth because of the high base. So absolute volume will be great, but in terms of growth, maybe it will be a little tempered down.
So you're saying expect the highest ever monthly sales in September in the Indian auto industry. This is particularly for Maruti, right? The overall wholesale sales is what you're talking about.
Yes, overall industry, I'm saying.
Can you break it down for us and what's happening with the small car segment? Because, you know, year to date, if you look at it, the mini and the compact car segment has seen a fall of almost 9%. Is there any recovery in that pocket at all?
At the moment, I haven't seen that recovery. So the indicators still are that the small car segment would be roughly 31% of the overall industry. Last year it was 34%. Our projections for this year, full year, financial year, is also that it should be roughly around that 31%. So it is under a little bit of stress. On the other hand, SUVs obviously are doing very well, and they are now almost 47% of the overall market.
So you're saying there is no recovery yet in the small car segment, which is the mini and compact car segment, and there is still a lot of stress there. But in terms of numbers, I think 4.12 lakh units is how much you sold year to date. So by the end of the year, what would the fall be? If you look at just the mini car segment, it's been in excess of 30% the fall year to date. So what are we looking at by the end of the year in this space? And when do you see the recovery come through?
Yeah, so part of the that decline that you just mentioned obviously is because on the base side we had the Alto 800, which is no longer there. Alto 800 used to sell about 11,000 vehicles a month, and that has suddenly disappeared. So some of the figure might be a little misleading, the negatives, and obviously later on the base of Alto 800 will not be present, especially the second half of last year it wasn't there. So you would see in terms of the absolute, in terms of the volumes going down, in percentage terms, may actually not be as high as what you saw in H1.
Okay, got that. I had a couple of more very quick questions. This year, Maruti has gained market share despite the kind of stress that we've seen in the lower end of the market, right? So that is commendable. So I'm guessing as and when the lower end picks up, the market share will improve further. But can you give us the numbers right now? What is the SUV market share as of September end? And are you on track to meet that 25% target that you had laid out by the end of FY24?
Yes. We look like we are on track. In fact, we were the number one SUV makers in July and in August as well. In August, on the cumulative basis also, we became number one. We were number 4 last year. So one of the clear objectives which we had stated at the beginning of the year was to be number one SUV makers in the country. And we have become in a short time, in fact, in July and now August as well. And hopefully in September also. So we are on track for that. Our market share in August was around 24%, 23.6% in the SUV space. So we are also on track to achieve that objective of 25%, which looked really heavy. But then some of our new SUVs done really well. The Vitara, the Fronx, the Jimny, they have done quite well. And therefore, with the increased production levels also, I think we are very well on track to meet our objectives in the SUV space.
Okay, so you're on track to meet the 25% SUV market share target by the end of FY24. You're already at 23.6% as of the month of August, got that. You know, SIAM had projected that the passenger vehicle industry will grow 5 to 7% in FY24. But given the kind of improvement in trends that you're seeing, do you think that the industry could outperform SIAM's projections? And what are your own targets?
Yeah, so actually I was part of that SIAM, panel which predicted 5 to 7% growth at the beginning of the year. And we had looked at all parameters and said that it would be around the 4.1 million mark will be the industry sale overall against the 3.89 million that we saw last year. And we have, I think the H1 results so far show that we are on track for that. I don't expect growths to be exceeding these numbers because, the base effect really will kick in from this month. In fact, despite all the pluses that we have just spoken about, by the end of September, that is H1 of financial year, I would expect industry growth to be around the 6.7, 6.8% mark already. So, and going forward to keep maintaining that growth on a high base will be tough, but I think we will stick by the original projection of 5 to 7% growth.
Okay, just one final question, because EVs are the flavor and the whole industry is sort of booming with new launches in the EV space. I understand that you have your target on track by FY25, you plan to launch the EV, but what's the update over there? Earlier you had also said that by FY31 you expect to have 6 EV models that would contribute 15 to 20% to your total sales. Are you on track to doing that?
Yes, absolutely. So you're absolutely right, Sonia. Our projection is that the industry will be 17% EVs by 2030. And in our powertrains, 15% will be EVs. We will be having 6 EVs in different sectors, first of which we will be launching in the mid SUV space next year. And preparations are on because it requires a lot building up of an ecosystem. So it's a little different from what other manufacturers have been doing, just launching vehicles. But we are looking at the entire ecosystem, including how not to inconvenience our consumers as far as charging infrastructure is concerned, or also because we expect a lot of queries being a new technology regarding the EV. So we are preparing to the entire ecosystem and not just a vehicle to be launched.
All right, Mr. Srivastava, thanks so much for stopping by and filling us in with a quick update. Wishing you all the best, particularly ahead of the festive season. Well, then, structural steel tubes producer APL Apollo Tubes, that's a stock on our radar. The promoter entity, that's Mr. Rahul Gupta, in August sold close to 15 lakh shares. To discuss this, also how the overall trends are shaping up, we have Mr. Deepak Goel, the Director Operation and Group CFO at APL Apollo Tubes, joins us on the show. Hi, Mr. Goel. Good morning. Thanks so much for joining in. Well, the market wants to know.
Yeah, good morning. It's our pleasure, sir.
If the promoter entity wants to sell any further shares in the company, because they have been selling periodically in the last few years and created big wealth as well for shareholders. So will they look to sell any more stake? Point number one. And point number two, what will this money be used for? Will it be used to fund their NBFC, or do they want to put it in the stock market?
Your first question is no further plan of sale any promoter equity. And it's a personal commitment at the promoters levels. That's why they have sold some quantity, because it's the only source of the incomes with the promoters. He is only focused on the APL Apollo Tubes. So his shareholding is very it's below the 30%, but they have some personal commitments. That's why they have sold the sales.
Is that personal commitment to do with that NBFC that they have in their personal holding?
Yeah, they have infused some money in the NBFC also, and some others family commitments.
But do they want to, maybe deploy some money in the stock market? Because there are some rumors that maybe there could be another listed entity that they could be looking at. Is there any plans on that front? I don't want to take any names
No,
because
sir. I am
don't
not
want to
aware
put
of it, and he's
Yeah.
only focusing on the APL Apollo. He is not participating in the equity also. He is only focusing on the business. So he's investing in the other family commitments.
Okay, got it. All right. So for the time being, you're saying no further stake, and we'll have to wait by maybe some part of the money gets deployed in the NBFC, but you're not aware if he wants to put any money in the stock market.
Previous commitment only. It's the preferential issue. He took warrant in the NBFC company, and the balance amount is have to be paid in the NBFC.
Got it. All right. I wanted to ask you about the guidance that you had given us earlier. You were talking about EBITDA per ton moving to around 5,000 rupees per ton. Is that on course?
Yeah.
And also, I think in terms of volumes we were looking at volumes of close to around 2.95 to around 3 million tons for this year. That's on target, both those two factors?
Yeah. We are stick on our commitment, sir. And so we are targeting EBITDA is the 5,000 rupees plus. And for the next 3 years, we are targeting CAGR is 25 to 30%. Yeah.
Right. Mr. Goyal, hi, good morning. Last time you were on, one other aspect which I'd like to touch upon is you're the leader in the space, but there is also established steel players who are coming up. I mean, you've spoken about the Tatas in the space, JSW in the space, etc. And at that point, you'd said, well, competition will come, but it's healthy. Market is growing at a fairly healthy pace. How has that evolved since the last time we spoke? Any additional insights there? You told us that Tatas want to be at about 4 million ton capacity by 2030. By that time, you will be at 10 million tons. But any sense on how competition is evolving?
And competition is healthy right now, sir. And we are not facing any challenge from the JSW and Tata. They are our largest suppliers. We are taking HR coils only from the two suppliers, JSW and Tata only. So it will be a healthy competition, and currently we are not facing any challenge from the raw material sides, also from the competition in our structural tube sector, sir. They have their own segments, we have our own segments.
Okay. I want to understand what is the opportunity for you in the export market? How is the demand currently? Is there any sign of weakness? Because I think earlier you had said that you're targeting volumes of 150,000 tons in the export market by FY24. Are you on track to doing that? And what kind of growth do you see over the next 1 to 2 years?
Yeah, we are on track. Export is very small market for us. In the total overall volume, it's only less than 5%. So we have the specific market in the Middle East, in Europe, US, and we are mainly focusing on the large diameter pipes, which are not available in the overseas markets. So we are on our targets, and we are not facing any challenges in the export market also. Our target is very small for the export.
So from 5% currently, do you have plans to take it up further? If yes, how much would it look like, say, 3-4 years down the line?
It will be in the same range because our overall capacity will be increased in the next 3 years. So overall proportions of the 4 to 5% will remain the same. Further, I want to add, we are putting a new facility in Umalquin. So it will become by this year end. So export will be, we will plan from there only.
Okay, all right. Mr. Goyal, you're saying you're going to be growing volumes at 25 to 30%, and the EBITDA number will be around 5,000 rupees per ton. If I plug in the numbers, by FY26, you think you can do around 2,500 crores of EBITDA? That's a gettable number, right?
Sorry?
Plugging in the numbers, volume growth of 25 to 30% with a EBITDA per ton of 5,000 rupees per ton. So by FY26, the EBITDA number could be around 2,500 crores at least. I ask you this because at current valuation, the stock looks expensive. But going by the growth trajectory and the profitability, it may not be so expensive. So 2,500 crores in the next few years, that's doable?
Yes, yes. We are also targeting 2,500 by the FY26, sir. You are right, sir.
We got that out of the way. There's an incentive as well that you'll be baking in, right? Because you have the Raipur facility that's eligible for some incentives. Could you tell us what kind of a number are you baking in terms of incentives on a per annum basis?
Per annum, sir, it's around 50 crores every year we are expecting. So it's a incentive for the 15 years. State government of Chhattisgarh had given a package of 500 crores so for the period of 15 years. So we are expecting we will complete in the 10 years, and every year we expect 40 to 50 crores.
Okay,
It will be add on the bottom line, directly in the bottom line.
Okay, so incentives of 40-50 crores. Just hold on to that thought, sir. We have a new company that's listing, EMS Limited, with a gain of close to around 20%. We'll have the management with us at around 10:30 a.m. So we'll get further clarity on the company later on in the next half an hour or so. But Mr. Goel, we were having that chat and I was looking at your debt number. That's come down drastically as well. Any plans to include maybe a dividend policy? That'll excite shareholders as well, right? Is there a plan out there? And is there any inorganic growth that you'll be looking at? Because you're the market leader, there'll be a lot of smaller companies that will be struggling because you're growing at such a fast clip.
We have no, right now we have no plan for the inorganic acquisitions. Since our capacity utilization is still its 70% levels. First we reached the 5 million tons, then we will think upon for the 10 million tons we can acquire after 26 only. It's not right now.
Mr. Goel, sorry, I just want to come back to because it's a very lucrative market. There are a long runway for growth because the end markets will continue to grow at a fairly fast pace. What is the thinking? I mean, you said that JSW and Tata, for example, are the biggest supply. You source your raw material, but they are also in a way the largest threat, right? When they decide that they want to go big in this space, or are you saying, well, that is not a possibility?
I want to mention something here there, sir. It's a different products. They are in the raw material, in the HR coils, in the flat products. They have a capacity of 15-20 million tons. And pipe structural tubing is a very small, since the number of customer is more. And we have almost more than 1,000 customers. We have SKU is more than 3,000 SKUs. So it's a different game altogether, sir. It's a they have a bulk seller. We are a small retailers based dealer distribution networks.
But a lucrative market. That's why I was kind of. But it's lucrative,
it's a different
right?
ball game, sir. It's a different ball game.
Okay. All right. Mr. Goel, we'll leave it at that. Thank you for joining us, and you should come and speak to us more often. You have created a lot of wealth for shareholders. Appreciate that, and all the best for the future. By the way, just want to mention EMS Limited, right? It's listed, a very strong listing there. It's listed at a premium of 34% at 282 rupees a share. The company offers water and sewage infrastructure solutions. So basically, it's in that space. It operates in Uttar Pradesh, Bihar, Uttarakhand, etc. And it's not just sewage and water solutions, but they also undertake operations and maintenance for executed projects. So that is their space, and it's looking pretty good at the moment. Especially with the whole, Swachh Bharat Abhiyan, etc. And what's happening with the north, in the north. So this, company is a big beneficiary of the potential over there. Also, a lot of the fresh tenders that have been floated by the government, the company is looking at bagging them as well. But let's talk about the technicals of the market now. Mitesh Thakkar is joining in to give us his view. Mitesh, thanks for being with us. Your thoughts? The market is still down about 130 points. So, it's sort of the bulls have taken a backseat for a while. What do you do at this level? Is there a fresh short trade that you're looking at? And what about individual stocks?
So we actually hit the levels, which I was looking forward for the markets to test, which was 19,750 on the Nifty and approximately 45,000 on the Bank Nifty. The Bank Nifty made a low of around 45,054. But I think these are the levels where some kind of support should come in and a bounce back would happen. So we've taken some profits off on our short positions, even exploring a couple of long positions on the stock side. But the idea is that in case the Nifty starts getting below 19,720, 750, then I think I'll reverse those long positions. So it's a slightly a trade, which will be for number footer traders, people who can execute fast and move and more with some kind of pace. So we're taking a risky long position in that sense. I would suggest a buy on IEX. Disclaimer, we have recommended it to our clients as well. So buy here with a stop at about 130 for targets of 142. And the other one is a buy on Bandhan Bank. Keep a stop at about 247, look for targets of 265.
All right, Mitesh, thanks very much for that. We'll leave it there. We'll come back for more a little later. Manisha is going to be joining us on the other side for a quick check on the commodity space. 135 points lower, 19,770 on the index. Stay with us.
Welcome back to Bazaar Morning Call. Let's get a quick handle on what's happening in the world of commodities this morning. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, thank you for that, Sonia. I'm looking at profit-taking across sectors. So crude prices have declined. So has been the case with metals as well. Markets are reacting to the U.S. Fed statements yesterday. The interest rates were unchanged as expected, but the higher rate timelines is what is bothering the street here. Having said that, while we have seen China data come in better in the month of August vis-a-vis month-on-month basis, but the China's real estate firm Country Garden misses payment yet again, and that is also weighing onto the street, as is the fact that the strength in US dollar index, and you are looking at inventories increasing in many of these metals also weighing onto the prices. I'll start with steel right now, and we have seen the prices come off its 5-month highs. For steel, we have seen the China production kind of increase, but the JP Morgan report also suggests that we are looking at steel usage in China infrastructure building continue to be on the stronger side. When you look at the crude steel production from China for the month of August, it has seen a decline by 4.8%. That in turn also has been supportive. The steel as of now has seen a decline because of the macro picture, but markets do believe that as and when the China building season picks up, you could be looking at some support. One metal that has continued to decline for a third straight day today has been copper. We've seen inventories continue to gain almost 150,000 tons now, which is the highest since May 2022, is what's weighing onto the markets there. For copper also, when you look at the inventories in last 3 months, we have seen a jump up of 150%, and that's weighing on. This is what we've done in sense of overall inventory. So in June 2023, it was a deficit of 72,000. For July, it is at 19,000 tons. So the markets are looking at deficit continuing, while of course we have seen a bit of a decline there. Much of the inventories are now moving into LME, CME and Shanghai as well. But it's not just about copper, because when you look at nickel inventories, those are the highest since March 2023 also. Lead inventories have continued to gain as well. They are the highest since July 2021. And that tells you that the demand on ground is not so strong, is the reason we've seen the battery, the steel ingredients, those inventories continue to gain up. The only positive really comes in from zinc, where we have seen inventories actually decline. Here, the market has seen demand pick up in Europe and China, and that seems to be supportive. And that actually shows into prices also. So when you look at week-on-week prices, we have seen a decline everywhere except zinc, where it's nearly a percentage point of a gain. Aluminum also showing 1.5% of gains. The markets do believe that you will want to watch out for the Bank of England, Bank of Japan, that comes in today and tomorrow, and further direction would come in from that.
All right, Manisha, thanks a lot for that. Well, just a quick update on the market. We are at the lowest point of trade, so it's not looking good for the bulls at all. The Nifty has given up on that 19,750 mark with ease, and it's the Bank Nifty that's also exerting the pressure on the market. Let's slip into a quick break. On the other side, a chat lined up with our market master. Lata will be joined by veteran market watcher Sridhar Srivaram, investment director at ENAM Holdings.
No, it's not economy, it's markets this time. Despite the Fed's uber-hawkish forecast, India's mid-cap rally, just notice, is continuing today. It's only the large ones who are reacting. And that's going to be, the mid-caps are going to be the meat of my chat today with veteran market watcher Sridhar Srivaram, Director, ENAM Holdings. Sridhar, just let me read out a few facts before I come to you. In terms of mid-cap performance, in 2023, mid-caps and small-cap index have rallied 28%, while the Nifty has rallied only 9.9% to date. Within mid-caps, PSU index has rallied 35%. Standout gainers are PSU railway stocks, RVNL and IRFC gaining 138 to 140% each. Power PSUs, SJVN, of course, the government is taking advantage of it, and transformers and rectifiers gaining 120 to 200% each. And PSU banks, Bank of Maharashtra, Central Bank, IOB, UCO and Indian gaining 47 to 55% each year to date. Now, Sridhar called out the PSU bank rally almost a year ago, and that's the reason why I have invited him. But Sridhar, just to keep with the theme of the morning.
Sure.
First, thank you for coming to the studio.
No, thanks for inviting me.
This Fed statement, I mean, what stood out for me is they've doubled the GDP forecast from 1% to 2.1%. So really, is this just an immediate reaction and we are actually in for some safety for the equities world over?
Yeah, so I think there's good and bad news. So the good news, of course, is that there's no recession or a hard landing. Maybe there is a recession at some point, but it's a soft landing being managed. And the bad news is that that inflation is stickier and higher for longer. And so I'm not sure how Fed can manage this in terms of bringing the rates down. I think it's some time away. At least
Yes,
maybe there is another rate hike.
by their own forecast.
Yeah, maybe there's another rate hike. Who knows? And crude is already where it is beyond 95. And US has a larger impact on commodities than the Indian inflation because CPI in India has a much lower weightage on some of these. So I think we have to brace for higher inflation and longer higher rates for a much longer period. And that's how I would look at it. Okay. Good news, of course, is that the economy is doing well. So the markets will have to, somehow brace both of the good and the bad news and see how it goes.
A terrible cataclysmic fall doesn't seem going by the way
exactly.
they've said. Both even actually unemployment is revised lower
than
earlier. Okay, so now let me come to the big thing for which I called you. A year ago, I heard you say on Sonia's show that you would...
so Lata, sorry to stop you. It was February 21, so it's 2.5 years back.
Shucks.
And we started investing sometime in November of 20. So that's when we started.
Either you're a rich guy, either you're a rich man. Okay, let me come to the meat of the story. PSU banks. I mean, everything has run in the first place. You've got Central Bank, UCO, all of them rising day after day, 20%. Plus Bank of Maharashtra, a stock that you had spoken about earlier. So do you still go for some of these stocks? I'm now referring to the mid-small PSU banks. I'll come to the larger ones.
So Lata, the way we look at it is that one, the mistake the markets and many of us have made is to look at PSU banks as a homogeneous entity and say, okay, I buy PSU banks at half book and sell them at one book. But what has happened is as we've gone and we've analyzed some of these banks in a lot of detail, you have banks with ROA of almost 2% to banks which have ROA of 0.5%. How can you give the same multiple for a PSU bank which has such varied, return on asset? Generally, you say 1% ROA is great. If a bank is generating almost close to 2% ROA, I mean, it's almost close to a private sector efficiency bank, then what sort of multiple will you give? I'm not here to judge what should be the right multiple, but this is how we are seeing it. So to say that, you mentioned a few names, I'm not going to get into specifics. Within that, some of them are really efficient. I mean, I want to refer to a private sector CFO who mentioned recently that, listen, we are struggling to, get a 30% CASA and look at this PSU bank, it has 53% CASA. So I'm really envying and I'm wondering what they're doing right. So this is the private sector talking about a PSU bank. I think things have really changed over the last 3-4 years where I don't think the deposit market share is falling anymore. That's how I would put it. I think there's still a lot of room, but you have to be very selective. Some of them have moved without much of fundamentals. But some, I would argue, have a lot more steam to go.
Okay, I know you can't talk stocks, but if I'm not mistaken, it is Bank of Maharashtra which has got over 50% CASA. You're not saying it. I think that's what Google is telling me. Okay, let me come to the... therefore, you would take ROA as an important consideration while investing.
So Lata, when you're looking at banks, you look at ROA, you look at ROE, price to book. And I have started looking at, the deposits, the liability franchise very closely because, we know that we are into a great credit cycle and this will end at some point of time. So I'm happier with banks which have a lower cost of funds because if my cost of funds are lower, I don't need to take that much risk to generate my, returns. So we are looking at various parameters. So I cannot say that one is more important than the other. Coverage ratio is the other one which we would look at. So I think there's a multiple factors. But in our filters, we still find, at least 4 or 5 PSU banks which still may have, room to go.
51% from what I last gather, maybe my data is a little backdated for Bank of Maharashtra and even Central Bank actually fairly decent. I think it's 49% for Central Bank. But, would you not worry about other things? Like margins are crunching for everybody. Reserve Bank has kept liquidity tight. Now the repo is closer to 6.75, 6.8. So margins are over. And even the credit cost story, fallen. But is there more room to go in many banks?
So I would say that barring 2 banks, which is, I think, SBI and BOB, where the credit cost has fallen below 100 basis points. SBI is almost 50 basis points. I think there's still room for a lot of the others. We're still in the 1 to 1.5% range. And, back in February 2001, when I had come and told the story, at that time the credit cost for most of the banks were 2.5. And our view was that credit cost will fall to 1.5. Obviously, we are changing our view now because we never anticipated that the environment will become so benign that even a bank like SBI is having only 50 basis points of credit cost. So we are having to relook at it. And our general view on PSU banks have always been that this is not a structural story. It's a cyclical story. We are playing that cyclical story. But as we've played, the environment has improved. So in normal circumstances, maybe in 2 years, we would have moved on to something else. In this case, it's been almost 3 years. And we are still seeing a lot of opportunity in staying on with this story because the environment has changed. Having said that, we keep a very close watch on some of these because, as you know, if credit environment changes, a lot of this can, change overnight.
Oh, absolutely. Well, to tell you, even the regulator becomes cleverer.
Yes.
They have something called that Krill or Krill C, which they've created,
yes,
where the moment they default that week itself, on that Friday, banks have to report. So this accumulation, or banks playing one bank against the other, borrowers playing one bank against the other. The cycle may not repeat with the same ferocity that it did. But who is to say? Let me come to the private sector. Some of them old private sector, some of them even new. Those have also done extremely well. South Indian, I remember, did very well. Karnataka did very well. So are you also looking at the mid-cap, private sector banks?
So Lata, we do have some of the mid-cap private sector banks in our portfolio. And having said that, we do analyze the balance sheets very carefully. And in some of them, I'm finding, red signals. You'll remember that many years back, I had highlighted to you a Yes Bank red signal. The easiest thing for us is to, move out of, banks. We are not hedge funds to short. So we just move out of those stocks when we find red flags. We are currently finding some red flags in the smaller private sector banks. And when the RBI...
Red flags is in the nature of what?
In
unsecured
the
loans being big?
I don't want to get into too many details.
No, but what kind of red flags, if you can educate us on
that? Some of the expenses are very high. Okay. Obviously, the other thing is that the red flag also comes from the fact that the RBI governor has put out a statement. So I'm not saying this. The RBI governor is on record saying that banks are evergreening, and he's put out a host of ways that they're doing. When the governor puts out this, it's only fair on our part to relook at the balance sheet and see if some of them matches. In our view, in some cases it does. So we don't have really enough proof, and we're not very sure why the governor just stopped at making a statement like that and then did nothing. So the best thing for us is
they are doing it through supervision, maybe.
Maybe.
Not,
so as investors, we don't have more information. So we just, where we think there are red flags, we just move out of those stocks. But we don't have enough proof to justify what we are saying.
Okay, let me ask this because, I will be running short of time. How many PSU banks do you have in your portfolio?
We'll have 3 or 4.
Okay.
PSU banks.
So I'll try to deduct from that.
Yeah.
What about railways, power stocks? Okay, more than railways, it is power that's doing very well, and across the board, both private and... are you playing that space?
So we earlier had played, now we are not there. But in general, I think, I'll go back to, say, 3 years back. The entire PSU basket had just about a 10 lakh crore market cap. And I remember mentioning this number because we were watching this very closely. Just Reliance had more market cap than all the PSUs put together then. Today, it's almost 25 lakh crores. I'm excluding LIC because LIC was not there in the calculation at that point of time. And I remember having recommended, for the investors that you just buy a PSU fund. And one of the, mutual funds from then to today in 2.5 years has doubled. So it's almost 30%, IRR return for the investor. Is there more juice left in the entire PSU basket? I think it is no longer as attractive as it was 3 years back. You have to look at it from a case to case. So even that is the case even with the power stocks. So you have to look at it from a case to case. If there is earnings growth, is this high valuation sustainable? So I'm not as gung-ho as I was, say, 1 year back or 2 years back on the entire PSU basket. Yes, specific PSU banks, I think there's still a lot of room. Like defense was a theme we played, but the stocks have rallied a lot. I mean, every time there's an order,
200%.
Yeah, these stocks go up. So at some point, you look at it and then say, okay, is the risk reward in my favor? Maybe it's not. It is left to individuals to decide if a fund wants to play that. We have taken a view where we should, book profits and move on.
Okay, well, actually, defense I didn't put in that list, but you have seen BEML, BEL, all of them up between 35 and 60%. Okay, a final question, with caps generally.
Yes.
I mean, there are some signs of froth which I would worry. I mean, there are a lot of mistakes being done in the options trades. As well, I think our derivatives volume is like 5 times US derivatives volume. So is there anything about the mid-cap rally of 28% that would alert you?
No, of course. It is a red signal because the index is up 28%, but there are pockets which are up 100%, and there isn't enough revenue or profits to justify some of these moves. Having said that, we do own a lot of mid-caps, and I think where there is earnings cushion, we are happier to hold. Sometimes what happens is that stocks we like move up much faster. We would expect a move of, say, 30-40% to happen over a year's time or 1.5 years. It happens in a month. But it's not. These are stocks which is not easy to buy and sell. So then you just hold on, knowing that there's possibly the correction, and you would, hold on and play the entire rally. So these sort of irrational exuberance happens where there is earnings support. I would clearly hold. Where it is more froth and a theme, or there isn't earnings support, I think those individuals they should have a serious look at it. But today the retail investors are so gung-ho about mid-caps. Look at the mid-cap funds which are getting the subscription. I mean, they're going through the roof. Even the fund managers are struggling to buy stocks in their fund. So I think there are red signals here. But overall, I think we still remain constructive on stocks.
I may be fired for going out of time now, but one sentence on HDFC Bank. Is it now good enough to buy?
Lata, we will not. I don't want to comment on individual stocks, but we generally are bullish on the large cap private sector bank, and especially some of them which have underperformed. We think that this is just a cyclical phase where the performance has come. Over a period, these have always generated. If I take a 10-year return of the top 3 banks, they are in the 18 to 20% range. And I have no reason to believe that this will not be the case in the next 10 years.
Why should it change suddenly? Yes. Point taken. Thank you very much, Sridhar.
Thanks, Lata,
for a most useful conversation, I would assume, if I were an investor. Wrap up on Bazaar, Chartbusters coming up.